Hello and welcome to this very special show, Charting 2016. It's all about technicals, the next half an hour. We spend such a lot of time on fundamentals, figuring out the global problems, the problems in China, what has led to this huge sell-off in global and Indian markets since the start of 2016. But over the next half an hour, what we'll try to attempt to do with two of our country's best-known chartists is what the technical picture is after such price damage and whether there's sign of any kind of a bottom formation in the near term. Atul Suri of Rare and Gautam Shah of JM joined me to take you through the technicals for 2016. Gentlemen, thank you very much for joining in this very special show. Atul, let me start with you. What is the Nifty prognosis after the kind of damage that you've seen since the start of this year?
So Udayan, we kind of topped out at 9,119 sometime in March 2015, and though we thought we would go to 10,000 plus, but subsequently we noticed that the market has started making lower tops, which is a very simple way of looking that things are kind of topping out. And over the months, in the technical terms, we saw a creation of a pattern which is called a shoulder head shoulder, which had a neckline at 8,000. So the target for this kind of pattern was set at around 6,900, which incidentally we kind of hit on Friday. So really, this script was written, and we have kind of met our target. The question that comes up for a trader is that, do I really go in and go long right now? Or if I'm sitting on some sort of cash as an investor, do I really go in and invest? Purely looking at the Nifty, maybe it's an interesting point. Maybe it's kind of a floor that is there. But when I look broader, when I look at global markets, I really don't think we are there. And 2008 has taught us that it's a little foolhardy to think that we will buck global trends. So when I look at something broader, like let's say the FTSE World Index, which is like 47 countries, 7,400 stocks, developing markets, developed markets, I do notice that even those markets have made similar patterns, and it's kind of a global sell-off, and they still have to meet their targets. So I won't be surprised that you may continue to see global weakness. Yes, you do see short covering bounces like we saw on Monday, but I do think that global markets will have to go through some more pain. So as I said, I don't think there's going to be a massive damage or a massive cut, but really is it time enough to go there and buy? Yes, if you're a long-term investor, etc., and you do it in stage-wise, it makes sense. But for a trader, I think there has to be confirmations. There has to be some sort of base building that has to happen. Markets will not just go up vertically. There will be some base building. They will pull up. They will retest lows or something like that and start making higher bottoms. I think that's when I would be more comfortable to sort of look at the markets. So standalone, the Nifty, I feel, has met its targets. But globally, I think charts are not so impressive. And more so, for India, if you look at the biggest villain has been the FII sell figure. And, if you look further, you have the MSCI Emerging Market Index, which I think is very much as to what is really happening in our space and why this sell figure has been coming. And that's been a pretty weak spot. In fact, I think the weakest global spot has been the Emerging Market Index. India is a subset of that, and that is why you're seeing this consistent selling. On Monday, in spite of such a good Nifty day, probably one of the best days of the year, you still see a very big sell figure. So I think that the foreigners are not going to stop selling. The whole emerging market basket, I think, has a little more to go. Yes, some will get relatively less affected, some will get more affected. India, I think, will get less affected because, as I said, based on charts, I think we've hit. But it's too early to just go in and put your money all in, to be all in this trade. There has to be base building. And base building also is important because it helps us to identify sectors and stocks, which hopefully would lead the next rally. So I feel it's time to look at markets closely, identify stocks, identify sectors, and look for a higher bottoming formation. Looking for a basing formation, a higher bottom, higher top is something that will really convince me that we are somewhere there.
Gautam, comment on this. Last time I read your comments, you were fairly constructive on the market. Have you changed your view since then? Does it look like this is a different kind of a market that we are living in today?
Yes, Udayan, it does look like, and I think India really joined the herd in the month of January. The way we see it, I think 2016 is going to be a tricky and challenging year for equity markets. I think if you really map the price action from last February to this February, I think what you'll notice is that while the market has seen pullback rallies of 400, 500 points from time to time, we've still broadly made lower tops and lower bottoms quite consistently. And I think till about December last year, we were holding the view that maybe India will stand out even if global markets were to correct. And I think for about 6 months, Indian markets did stand out, and we did see a lot of outperformance because the market kept rebounding from that level of 7,500. But when that level broke in the first week of January, I think that was a sort of an indication that the Indian markets have joined the global herd, and thereafter we've just moved in tandem. And the fashion in which some of the important supports have been broken in the last few weeks, initially 7,500 and then 7,150, 7,200, I think is a sort of an indication that clearly I think the markets are in for the downside. I think I have a few concerns right now, and that concern is not visible on the Sensex and on the Nifty chart, because you have a market which has been in a downtrend for the last 1 year. I still do not want to call it a bear market, because I think while the Nifty has lost more than 20% from the top, the mid-cap index has still not done even 20%, and it's actually outperformed the mainline indices. And this is very rare. If you look at the history of Indian markets for the last 10, 15, 20 years, rarely have you seen a major downtrend with the mid-caps actually outperforming the larger ones. So that's something which tells you that this might be very different to 2008. Having said that, I think from a near-term perspective, the way the mid-cap index is shaping up, the way the Nifty Junior is shaping up, I think that gives us a little bit of a concern, because those charts have only seen a breakdown in the last 2 weeks, and they are pointing out to a 10 to 12% drop from current levels. And if that were to play out, I think the Sensex and Nifty will have to move in tandem. Maybe the damage will not be as large as some of the other sectors in the market, but yes, there could be more downside, and I remain quite worried about the way some of the global charts are placed at this point of time.
Sure, we'll talk about that. But Atul, what are your thoughts on this? Because through 2015, what we heard was a common refrain from a lot of investors that, yes, the Nifty is down and the Sensex is down, but our portfolios are not looking that bad. So individual stocks have given returns. Do you see that changing around in 2016 with a lot more pain inflicted on portfolios? I mean, for example, are these broader indices like the CNX Midcap Index or the CNX 500 telling you now, technically?
So if you look at this, the CNX Midcap 100, you'll notice that through all of 2015, where on the frontline indexes there was a lot of pain, this thing kind of trended between 12,000 to 14,000 kind of range. And it held out very well, and obviously we were all very smug that our portfolios are holding out. Now 12,000 becomes a very important level, Udayan, technically, and just as we had breakdowns below 8,000 for the Nifty, and it got pretty nasty after that. The level is around 12,000 for the CNX Nifty 100, and we are just below that. So essentially, the breakdowns in the mid-cap index have happened very recently, maybe just a week or 10 days ago. So the risk that we run is that even though we may not see much damage in the frontline Nifty or the larger caps, we could see this kind of damage that is happening. And if we really sort of compute, from around, we could see almost a fall to around 10,000 on the CNX mid cap, and that I think will be the pain point. That is when it's not that people have not been feeling the pain; they have been feeling the pain already. But I think that's when you will really see, even the delivery-based investors throwing in the towel. So we are at that point. As I said, the silver lining for me is that probably the Nifty per se will kind of hold out, and the impact or the fall would be less. But yes, individual stocks are prone to some sort of accidents and things like that, and we are seeing that in the pharma space, which I thought was one of the finest sector trends that we've been seeing in many years. And you do see that stocks in a week lose 20-25%. So that is the kind of risk, we run that risk of accidents. So that is why I feel that it's going to be very important to see not just stocks that fall, but actually stocks that hold out, because this is also a time for us to analyze and sort of keep our antennas up and look that in case markets turn, in case post-correction, how things are. What are the stocks that have behaved themselves well? And I think we are in that phase. For me personally, I'm looking out for those kind of stocks which do not fall, or which are holding out very well, or which are seeing that kind of buying. Because very often I've seen, especially in 2008, that they have been the leaders of the next rally. I know it's too early to talk about that, but I guess you have to be one step ahead. And mid-caps are looking wishy-washy. But I, for one, would look for those which are holding out, because I know that they could be the next winners of the next run.
Gautam, what's your downside target for the Nifty? Both of you seem to be saying that there is some downside, but not a huge amount of downside. So, I mean, there was some talk when the market broke down a few weeks back that we could be going all the way back to retest the previous top of the market, which was 6,300 Nifty. What probability would you assign to that?
Well, I think that would really be the worst case for 2016, because I still feel that Indian market should be an outperformer. I still have a half-glass full approach for the Indian markets if I really take a 3-year or 5-year view. So in that sense, I think 2016 might just be a great opportunity for investors to gradually get in. But I think at any point of time, if 6870 or 6900, where we tested last week, if that were to get broken, I think that will automatically open up a move down to about 6650, and then eventually down to about 63-6400. Now 63-6400 obviously is extremely important, because it was almost a 5-year breakout that happened in 2014, and one must not forget that late 2013, early 2015, you had the Nifty rallying about 80%, 5,000 to about 9,000. So that was a pretty serious move, and till the Nifty is actually safe above 63-6400, we will have to believe that the India story is intact, and we will have to believe in our long-term targets. And I would still stick my neck out and say that between 6,500 and 7,000 looks like a great buying opportunity for long-term investors having a 3-year, 5-year view.
A quick break at this point. We'll be back with charting 2016 after the break.